and welcome to the Global View on this Tuesday. I'm Andrew Gagan. Good to have you with us here at ausbiz. So let's take a look at what happened overnight. Investor sentiment mixed, with markets weighing up the size of the expected rate cut from the FOMC later this week. Rate-sensitive tech stocks dragged on Wall Street's indices, taking the Nasdaq lower. The S&P 500 finished in the green in choppy trade, while the Dow closed at a new record high. Apple fell after an analyst from TF International Securities said demand for its latest iPhone 16 models was lower than expected. Those demand concerns weighed on the chip makers, with Nvidia down along with Broadcom and Micron Technology. Intel shares surged after reports showed it qualified for as much as $3.5 billion in federal grants to make semiconductors for the US Department of Defense. Boeing dropped after the aircraft manufacturer said it was freezing hiring as its workers' strike stretched into its fourth day. And US-listed shares of BHP and Rio Tinto were up more than 1%. Well, in the latest read on US economic activity, the New York Fed manufacturing survey beat forecasts, with new orders and hours worked rising while pricing components were contained. Meanwhile, former New York Fed President Bill Dudley has reiterated his call for the Policy Setting Committee to make a big cut at its meeting this week, saying monetary policy is tight when it should be neutral or even easy. And a bigger move now makes it easier for the Fed to align its projections with market expectations rather than delivering an unpleasant surprise not warranted by the economic outlook. Well, the US two-year Treasury yield has fallen to its lowest level in 2 years as investors contemplate the odds of a 0.5% rate cut by the Fed. The two-year yield falling to 3.52%, and the 10-year was down to 3.62. And the probability of the 50 basis point easing was last seen at 61%. That's according to LSEG calculations. And the US dollar has fallen to a more than 1 year low against the yen on expectations of a supersized interest rate cut. The Aussie has risen to 67.5 US cents. So let's get across particularly what we're seeing on Wall Street and other markets in response to, well, what's looming as a rate cut by the Fed. The question is, of course, by how much? Steve Sosnick joining us from Interactive Brokers. Steve, great to have you back on the show. It's been a couple of weeks. Of course, it is all about the Fed this week. Let me first start with those comments from Bill Dudley, the former New York Fed president. What did you make of that? I mean, he's asking or saying that they should go aggressively in this first meeting.
Dudley, well, first of all, great to see you again, Andrew. Bill Dudley has been quite vocal in his advocacy for 50 basis points. This has been going on. He's a Bloomberg columnist now. He uses that platform to basically advocate for more extensive rate cuts. It is important to remember that when he was the head of the New York Fed, he had a very big voice in monetary policy. But as a retired New York Fed president, I don't know how much his voice resonates within the Fed. It certainly resonates a lot outside the Fed. It's kind of interesting because I think, there was what turned things around last week in terms of Fed expectations was an article in the Wall Street Journal, from sort of their resident Fed whisperer, basically saying that, leaving the door open very much for a 50 basis point cut. The odds had fallen down to about, 14, 15% or something like that for the bigger cut. But then that journal article came out. There's really, some people saying, well, no one's pushed back on it from the Fed. And that's a very valid comment, except for the fact that the Fed is in a quiet period. So the people who are on the Fed now can't say anything. But the feeling was that story was put out into the Wall Street Journal, basically to get the point across. And then, someone as prominent as Bill Dudley keeps advocating for the bigger rate cuts. And here we stand now with essentially the 50 basis point cut largely getting priced in. It's 2 to 1 chance that it happens rather than not.
Yet, I take your point. You say the Fed doesn't like to surprise markets, but is it inevitable that it is going to surprise markets? Because it is something of a coin toss, isn't it, whether it goes 25 or 50?
It's going to surprise somebody, right? I mean, even when it was 50-50 as of Friday, today it's, again, as you put it, sort of 66-33, something of that nature. But that still means a third of the market participants are going to be surprised. So we're coming into this without a real consensus, and that's something we're not really used to. Usually the Fed has been pretty clear about being all on the same page here. So it'll be interesting to hear what sort of dissents there might be. And in terms of, it doesn't remove the will they, won't they aspect to it. Another thing to keep in mind is we get another summary of economic projections, the dot plot, as it were. And it'll be interesting to see if the FOMC members sort of share the market's enthusiasm for rate cuts. They're pricing in basically 10 rate cuts, 2.5% by the end of 2025. And that's reflected, of course, in the 2-year pricing that you referred to earlier as well. And 5 rate cuts now by the end of the year, with 3 meetings left to go. So it'll be interesting to see if the Fed, whether or not they do 25, right ahead of an election, by the way, which means they're going to get one side or the other, or both, are going to complain about what the Fed does. And then, of course, do we continue to get these rate cuts so aggressively? And does the FOMC share the market's enthusiasm for such aggressive rate cuts?
Steve, you mentioned the election. Does politics play a part here? I mean, clearly, it's all about the independence of the Fed. Nonetheless, it is such an important event. Of course, it is influencing markets. Does it influence monetary policy?
It's a great question. In theory, they say they're apolitical. In reality, they have, Chairman Powell or whoever's the chairman has to go in front of Congress twice a year and listen to it all. And this cycle specifically, the former president has more or less said that he would like to remove a lot of the central bank's independence. The current administration certainly doesn't go that far, though there are Democratic senators coming out today saying, forget 50, let's go right to 75. So, somebody's going to be unhappy no matter what. My gut still is with the 25. I guess maybe, as a trader, I have to respect what the market's saying, but intellectually, I'm still with the 25. Basically on the theory that it's less disruptive politically. It's been so well telegraphed that really no one can complain about that one. Well, people will, but no one should be able to. It's also almost impossible to argue that even though they say that rates are restrictive, we have the stock market at all-time highs. No one's really complaining that they can't get access to money that they need. There's no signs really of monetary stress. So, I understand the idea of the Fed keeping its word because they more or less said that they're going to cut rates at this meeting no matter what. But the question to me is, I think here's where the dilemma comes in. The Fed may not want to signal that they see that they're that worried about the economy, but then on the other hand, does the market react that the market's moving too slow, that the Fed's moving too slowly if it's 25, if it's 50? Is there some rhetoric that the Fed's panicking? And so I don't think we can declare full victory on the stable prices front because we did have a higher than expected PPI. We've had some higher than expected labor readings in the last payroll numbers. So it's such a disjointed meeting. On the other hand, if you give me another few minutes, I'll make the case for 50. Although but intellectually, I do stick with the 25s, even though the market may be telling me I'm wrong.
So, how do you think this is likely to play out as far as markets are concerned? I mean, you mentioned where we are, particularly with the equity market, and also you say that investors recognise that potential for volatility. What are you seeing there? I guess, particularly referencing the VIX.
Interestingly, the VIX and the S&P index options, because, now we have S&P index options that expire every day. Neither of them are really signaling a lot of nervousness. The 17 VIX, you see that was up about a half a point today. So we were in the 16s as of Friday. Now, remember, the VIX is looking ahead 30 days. I guess, at some level you can say, all right, well, the next 30 days might be somewhat quiet once we get past the Fed meeting, because then we have a few weeks to earnings season. And so there's sort of a glide path in there. I do think a lot, as I mentioned, a lot depends on the statements that comes out of the Fed, on Powell's press conference, where he usually tends to put a sunny spin on things, and the summary of economic projections. But then after that, the market really doesn't have a ton of big catalysts. Obviously, the election is a huge catalyst, but that's not till November. And it's still pretty much a toss up. So it's not as though I haven't seen a lot of major investing money put one way or the other, in terms of Harris bets or Trump bets, because it's really impossible to know how this shakes out. And so maybe VIX is kind of looking beyond that, but um, you know, it's just a tough environment right here. You've got a situation where Nasdaq topped out about 6 weeks ago. The S&P is within spitting distance of an all-time high. The Dow, as you mentioned, is at an all-time high. Um, the last time I can think of that, where the Nasdaq topped out sort of 6 weeks before the S&P did, that was in November of 21 and January 2022, which I'm sincerely hoping is not the case now. But I do think we are seeing this is kind of the weird consequence of the broadening rally. Day like today, which was flat all day until maybe the last 10 minutes, where you had sort of the usual end of the day hijinks. Um, two advancers on the New York Stock Exchange outpaced decliners roughly 3-1. So that's the broadening rally, but it comes back to the idea that if the tech stocks are down, the S&P can't really move too far without them, and certainly Nasdaq is actually providing a little bit of weight on this on the broadening rally, and it's kind of up to the Fed at this point to make sure that the rally can continue. And let's see what happens.
Let's see what happens indeed. Steve, I look forward to next week where we can pick apart what the Fed's decision has been. Thanks so much for joining us from Interactive Brokers.
My pleasure as always. Talk to you next week. Take care.
All right, let's take a look at where we're likely to open when we get going in just a couple of minutes' time. As you can see, up 2/3% SPY futures there, which would take us to a new record high for the S&P 200. So obviously a positive session ahead for us. Stay with us because the open is just a couple of minutes away.